Hey, ODs on Finance, Dr. Aaron Neufeld, your co-founder and host of the video and podcast series. Today's video is with Collin McBirney. He's an equity analyst. He worked for Wells Fargo, PIMCO, and now currently runs his own hedge fund valued at about $35 million. He's going to talk about stocks, index funds, and mutual funds. Enjoy the video and podcast, and make sure to subscribe to our YouTube channel. Also subscribe to our podcast and visit the website odsonfinance.com. A couple of quick announcements while people are getting on the live event. Make sure to check out the website odsonfinance.com. We have a few updated articles from both me, Dat. Julie has an updated article on real estate investing. And also we have a few updated articles from our sponsors. Our CPA sponsor has written a great article on S-Corps, and also our real estate sponsor has written a great article on the physician's mortgage loan. So check all of that out. And the other thing is our refi partner page. We updated all of that, so even lower rates than before. Some refi partners are going as low as 1.9%, which is great for student loans. So take a look at that page. And let me see, anything else? If you haven't bought the book yet, please do buy the book. We've had about 500 people buy it, which is, we're very happy about that. A lot of money that we're going to be donating to Vosh at the end of the year. And also a good amount of money that's going to go into the scholarship fund that we're creating. So we're super excited about that. Dat is updating the website pretty much every day. So just keep a lookout for that. Looks like we got some people online now. So what we're talking about today is everything related to stocks, index funds, mutual funds, all of that. And who we have with us today is Collin McBirney. He is an equity analyst. And Collin, if you can just go through just a kind of a quick history of your career with stocks, what you were involved in with the short and the long-term game, and yeah, if you can just go through your career.
Yeah, sounds good. Awesome. Well, thanks for having me on the show, and looking forward to talking with everyone. I went to school at Berkeley, graduated in 2011. Actually, majored in civil engineering, and discovered my passion for finance and investing while I was at Berkeley. So I went straight into finance after graduating. So worked a year at Wells Fargo on their proprietary trading desk, and then the last 6 years before launching the fund, I was an equity research analyst at PIMCO, and so there's a $500 million long-short fund there. So I was the lead research analyst for technology, financials, and industrials for this $500 million long-short fund. A little over a year ago, I left PIMCO, set up my own fund called Top Line Capital, and I've been running that since January. Right now, it's just me. Apologies for the boxes in the background. We're
all good.
We are remodeling our bathroom, so we have some faucets and light fixtures in the background there. So, I've been super interested in the market since bought my first stock in December 2007 when I was 18 or something at the time, and been basically just continuing to learn every day. And 10 years ago, I knew I wanted to go out and kind of start my own fund, and so been having fun kind of follow my dream running a fund. So
fantastic. And full disclosure, Collin and I were good friends in high school, and yeah, even in the high school days, he was interested in stocks and he was interested in the market from what I remember. So he's been in this for a long time, and yeah, he's got a good sharp mind. If you can just give us a quick overview just of stocks, mutual funds, index funds, hedge funds, just kind of differentiate the differences between them. We got a lot of early investors in our group, and so just giving us a quick overview, from someone that has a lot of experience in them would be great.
Sure. Yeah. Basically, So stocks are sort of the building blocks for mutual funds, index funds, and hedge funds, and so a stock is basically just a piece of a business that's publicly traded. And so the advantage for a company to be publicly traded as opposed to privately held is that the employees have liquidity, they have a publicly traded price. So when they grant stock options, they can grant that at a certain price. And so basically the way I evaluate stocks is trying to figure out how much the overall business is worth, and then dividing by the share count to come up with a price for the stock. So the stocks are sort of the building blocks for the other things, which are basically just financial products. And so a mutual fund is a financial product, an index fund is a financial product, and a hedge fund. a financial product. And so basically, I guess going in order, so a mutual. So when I worked at PIMCO, the long short fund I was on was actually structured as a mutual fund. And so back in 1940, there was this act called the 40 Act, which basically enabled the mutual fund structure. And so a mutual fund is basically just a pool of money. And so oftentimes it's more like it can be retail or institutional investors that invest the money, and then there'll be a mutual fund manager. And typically the mutual fund manager will charge anywhere between 0.3% to 1% or 1.2% at the high end in order in exchange for managing that. And so it's investors will come into the mutual fund, and then the mutual fund manager will decide kind of where to invest the money. And the benefits of a mutual fund are there's like daily price transparency, where there's an NAV put out every day, and there's it's kind of regulated under the 40 Act by the SEC. And so it's an investment product. And so PIMCO is a huge mutual fund company. Like Fidelity would be a huge mutual fund company for equities. There's like Capital Group, which is based here in LA. I'm in Santa Monica, and so Capital Group is a huge mutual fund company. So that's kind of one way to basically invest in a broad basket of stocks. Index funds. So basically, an index fund is, I guess they're mutual funds that try to track certain indices, and some people call those mutual funds, or some people call those index funds. And then there are also ETFs that basically you would track an index. And I mean, essentially, an index is just a basket of stocks, and so you can't necessarily, like the S&P 500 would be an index, the Russell 2000 is an index. There's indices for each country. The DAX index is an index of German stocks, and effectively it's just a basket of stocks. But then in order to invest in that basket of stocks, you need to find a financial product that basically is matching that. And so that could be a mutual fund could be trying to match the S&P. That would be like an index mutual fund, or there could be an ETF that could be trying to match the S&P, which would be a S&P index index fund. But yeah, so an index fund is sort of a basket of stocks, and there's index providers such as S&P and MSCI and these types of organizations that basically decide what stocks are in that basket and what stocks are not in that basket. And then finally, a hedge fund is isn't really an investment strategy or process. It's really more of a compensation scheme than like and so basically a hedge fund is differentiated from a mutual fund and like ETFs, and that there's almost always a performance fee associated with it. And there's a difference in legal structure. A hedge fund is typically a limited partnership. And so a different legal structure than an ETF and a mutual fund. But the primary kind of functional difference is that a hedge fund typically has a performance fee in addition to a management fee. But a hedge fund can do all sorts of things. So a hedge fund can invest in stocks. A hedge fund can trade futures. It can trade frequently. It can hold positions for a long time. It can do even buy businesses. It can buy real estate. You can do all sorts of things. But it's in the early days, the advantage of a hedge fund was that there was basically more financial flexibility than some of these like more regulated products. And so it's basically a less regulated fund that can have more flexibility to do things. And oftentimes there's a performance fee associated with it, as opposed to just a flat management fee like with a mutual fund and an ETF.
Okay, great. Yeah, I think that's a great explanation of all that. All right, we got a couple comments here. Perry Brill, what's up? Hey, what's up, Perry? And Dad has a comment. What was your first stock? That was his question.
So in 2000, December 2007, there were I had saved up some money in high school, and so this was right after graduating from high school. So I put my lifetime savings, which is about $2,000, into the stock market. So I got a Scott Trade account, and I'd pick 5 stocks that I thought I knew really well, and basically I knew what businesses they were in. I didn't know anything about, I was very, very green. And so I think one of them was like this broadcasting company called Citadel, which I think went bankrupt in 2008. There was another one that was like a mortgage REIT, which I think also went bankrupt in 2008. So
learn from your mistakes at the beginning.
And I was like, oh, I'm going to be a long-term investor in these 5 stocks. And then about 2 weeks later, I'd sold those, and I was aggressively trading on margin and doing all sorts of risky behavior and finding figured out a lot of different ways to lose money. Unfortunately, at the time, I didn't really have a lot of money to lose, so that was the
yeah. So I was good to learn early on. Yeah, when you got time to recover.
Yeah.
All right. Well, going off of the risky behavior, our next question. So in our book and website, we advocate for conservative DIY investing for the average optometrist to build wealth. And so that means a portfolio heavy and low-cost index funds that we just talked about. So what would be your ideal portfolio for this type of conservative DIY investor?
Yeah, I completely agree with your notion. I think you're spot on. I mean, I think that there's a lot of like books and different ideas and notions around investing and personal finances and stuff. I think they're at its essence, there are really like 2 rules to personal finance. It's like spend less money than you make, which means save money, and then second, like invest the difference reasonably well. And so I can't I'm not going to tell you how to spend your money, but I think if you spend less money than you make, you're going to be in a good spot. And then the second component to the second rule of personal finance, invest the money well. I mean, whenever people ask me for financial advice, it's always I always tell them to buy a low cost S&P index fund, and ideally do it over a multi-year period, only with money that you don't need to live off of. Don't use leverage, and if you're running your personal finances correctly, you're saving money on a monthly basis, and then you can take those savings and you can invest, even if it's a small amount every month into the S&P. And I'd say my biggest kind of difference compared to and I'm not a financial advisor. I run a fund that's happens to be structured as a hedge fund. But my biggest kind of difference in kind of from, I guess, the conventional view of diversification is I think that buying a low-cost S&P index fund provides sufficient diversification for you, and I would not recommend. Obviously you can consult your financial advisor or whatnot, but I would not personally. I would not recommend investing in emerging markets or Europe or all these sorts of other indices. And the reason for that is that the companies that are in the S&P 500 generate 45% of their profits from their international operations, and owning companies in the S&P 500, you get sufficient geographic diversification. You have professional management teams that are paid $20 million a year in order to hedge your currencies, hedge all these sort of risks. And I trust that. Like, I've looked at a lot of the companies that operate out of Brazil and Russia and the Middle East and all these sort of there's a whole bunch of companies that are listed there, and you can invest in these emerging market indices that buy those stocks. But the corporate governance there is not what it is in the U.S. The attitude toward minority owners of businesses is not the same as it is in the U.S. And the reason that over multiple decades the S&P consistently beats emerging market indices and all these sort of things, it's because these companies that are in the U.S. are profit machines, and they are sophisticated capital allocators. And so basically I would basically put all of your savings in the S&P and do it over a multi-year period and dollar cost average into it. I think SPY, I'm not associated or affiliated or anything, but I think SPY is liquid, it's low cost, it's sort of the easiest, and so I would just kind of keep things simple.
Yeah. And then going kind of on a tangent on that, we've got a lot of members in our group that trade individual stocks, and a lot that want to get into trading, that are asking questions about trading. What are some important values and metrics if you do want to get into individual stocks versus putting your money in the S&P?
Yeah. So earlier in my I guess investing career, I tried all sorts of short-term trading strategies, option strategies, using leverage, all this sort of stuff, and I actually didn't. Well, I kind of think I got out kind of break even, which was fairly good for 2007, 2009, but it was a lot of luck involved and a lot of stress and a lot of time. And so the last 7 years I've been following a much more like fundamentally oriented strategy where basically I evaluate the businesses and how much, basically how much revenue and free cash flow I think the business is going to generate in 3 to 5 years, and valuing the business on those future results. But I think that if you're new to investing and you want to do single stocks, I don't think there's anything necessarily. I don't think there's anything wrong with that at all. I think that's great. But I think that you should. I think that you should have appropriate expectations. And I think that you should ideally stick to. I think you need to discover a process that works for you. And I've studied a lot of successful investors, and I think that the one common theme that I've seen is there's people that can make money by trading, but oftentimes they dedicate their life to trading, and they don't just do it 30 minutes a day or something like that, because it's extremely competitive and it's extremely scalable. So like you could have like 0.5% of the people making all of the profits and 99.5% of the people losing money when you're in these kind of high frequency trading type arrangements. So I think just having a system, finding a process that is consistent with your personality and kind of the way your brain is wired and makes sense to you. And then I guess my personal advice is I guess just speaking from personal experience, I've observed that when I'm making investment decisions, the more I think and act like a business owner, the better my investment results are. And so oftentimes that means thinking like do I want to own this entire business? Like if I look at the value that the business is currently selling for, the number of shares outstanding times the price, is that kind of market cap attractive relative to the amount of cash flows the business is going to generate many years in the future. And I think investing in business you understand is an advantage, because it makes it so when there's inevitable, every single stock is going to have volatility. And I think if you understand the business and you understand kind of the direction, you have confidence in the business, you're able to ride through the inevitable drawdowns in the stocks and stuff. But I think it's you have to find an approach that works for you.
Yeah, definitely. And then another question that's been going on in our group is stocks versus bonds in your portfolio. What's your take on the allocation of stocks versus bonds related to age?
Yeah, that's a good question. So I worked at PIMCO for 6 years. I was an equity analyst there. 95% of what PIMCO does is bonds, and so I know a lot of people who do bonds and are experts in investing in bonds. I think there's nothing. I guess I personally like stocks more. I think, but I guess there's nothing wrong with bonds. I think that I guess given how low interest rates are, like it's hard to get a lot of return from investing in bonds. And so, if you're going to invest in bonds, like your alternative is accepting, a 1.8% return, which is sort of where the 10-year treasury is, or you could kind of take credit risk, which, the credit spreads are fairly tight now. And so you can invest in these kind of subpar companies and maybe you can get 5%. But if there's a recession, then you kind of stand to, make 5% a year. And then if there's a recession, then, you could lose 20% or all of your capital, which I don't think is a good trade-off. So if I look at like kind of how stocks are valued today versus how bonds are valued, I think stocks look much more attractive to me. But I'm biased because I run a stock fund and I'm passionate about stocks. And but I think like I guess if it were me, I'm not old, and I tend to try to avoid thinking about when I get old, just because it's not a pretty picture. I guess if it were me and I were like really old, I would keep like I don't see a lot of benefit in going into like long bonds. Like I would probably keep a portion of if I needed cash for the next probably the next like 3 to 5 years, and I didn't have any income and I was living off of my investments, I'd probably keep like enough very liquid investments for the next 3 to 5 years, and then invest the rest in stocks, and then maybe keep those like maybe keep it in like 2-year treasuries or something like that, which you maybe get whatever is 1.2, 1.5%, something like that. And so it's something, but like at least you're taking the risk. You're taking risk in stocks, and the stuff and the money that you need for the next couple of years is in very safe investments. So
yeah. And then, why don't you give us an overview of puts and calls? We have got a few optometrists on our forum that are into day trading, a few that are getting into day trading. We have some conversation about that. So
Yeah.
yeah, what's your opinion on day trading for someone that's working full time as a doctor? Is that even a good idea, or yeah, what's your take on that?
I think it's like probably it's well I mean it's probably about as bad as gambling, which isn't it's it's not terrible. People gamble for fun, and there's nothing. I don't think it's sinful or anything like that. But I don't think it's a good investment. I think that if you have a certain amount of money and you're like, I want to have fun and experience volatility with this money. I don't think there's anything sinful about trading or aggressively investing, but I don't think it's I haven't found it to be particularly lucrative. And so I would just I guess I would just compare your personal trading results over a multi-year period against what you can do from investing in a low cost index fund or something to that effect. But yeah, so basically a call option is basically gives the holder of the option the right to buy a stock or index fund at a given price, within a certain time frame, and so most of the listed options are 30 days, 60 days, or 90 days, and so you get the option to buy a given security at a certain price. And so basically, it's a way to express a leveraged bullish view on a given stock. Conversely, a put option is the option to sell a given stock or security at a certain price for a fixed period of time. And that's sort of a way to express a bearish view on a given stock or index. And I think that it's just important to remember, kind of like going to I don't play poker, but if I was going to go to a casino and sit down at a poker table, I would expect to lose a lot of money because I don't play poker and that's not my career. And there are a lot of people who do that for their job. And so I would expect they would take me to the cleaners and it's fine if I want to go and play poker and enjoy playing poker with these people who are really good at it. But I expect them to take my money, and that's fine. But you should just kind of go in with your eyes wide open that there's people who do this for their every day, and their job is to make money off of retail investors who don't do this for their job. And I think that it's sort of it's effectively like gambling, because there's the house take, which is the commissions, the bid ask spread, and then once you get past those, then it's sort of a zero sum game, and so you're basically going against professional traders who are managing the largest amount of money. And good luck.
I think that's a good analogy with the poker game. Yeah, it's just like with our profession, if someone was to go into our profession and try to do something, it wouldn't make much sense, but it happens. And let's see, what's the next question here. What are your predictions for 2020? There's a lot of people that are predicting a bear market, that there might be a crash in the next few months. We got the trade wars, there might be an impeachment of the president, and this upcoming election, who knows what's going to happen. So what are your thoughts? What are your takes? Should we keep investing in the market, or should we cash out for a little bit, hold money, and what should we do?
Yeah, it's a good question. So I think I guess working at a place like PIMCO, I got to see some of the brightest minds and their thought processes for predicting interest rates, predicting the future of stock market, predicting and PIMCO's kind of prides itself on being a macro oriented shop, which sort of means they focus on predicting where GDP is going and where these stock market indices are going and where interest rates are going, and try to make investment bets based on those factors. And in being inside that organization where these top minds making obscene amounts of money, I kind of saw that people were right approximately 50% of the time, and about 50% of the time they were wrong. And so there wasn't a whole lot of it's I guess the bottom line is it's very difficult to time the market, and I haven't seen many people who have successfully and profitably done that. I will, and I know that. I think part of it is people are I think there's some kind of human psychology behind this, because people, at least my personal experience is that a gain or a win kind of feels like 1 time's good, and then a loss feels like 10 times bad. And so there's sort of this asymmetry of emotional asymmetry where people are really focused on like avoiding losses, and I think that you combine that with like the media. I think naturally gravitates toward negative stories and stuff, and I think if you look at and so that kind of brings these kind of fear mongering to the surface and kind of top of mind for people. And I mean, I think if you look at the long term track record of owning stocks in the U.S., it's it's phenomenal, and it hasn't paid to be to bet against America really at any time in the last 100 years or so, or maybe 80 years. And so I mean, I guess I guess that there's also the negative narrative, like you said, the trade war, all this sort of stuff. I'll share with you some math, which maybe will just kind of provide some context for the current market's valuation, and just kind of provide some context. So I think so my wife actually hosted my 30th birthday party yesterday. We went roller skating, and so I was born November 19th, 1989, and so I looked at the valuation for the S&P kind of over my lifetime, because the data was readily available, and I feel kind of old now, and so I feel like it covers a pretty good span. And so if you look at that, the S&P basically is traded between 12 times forward PE and 24 times forward PE for that 30-year horizon. And so if you look at the average has been about 16 times PE, and today it's about 18 times PE. So it's about 12.5% above its long-term average. And so that sounds like it's bad because it's it's selling for more than it historically has, and it is. There's no doubt about it. However, I think if you look in the context of where else are you going to put your money, I think stocks still look relatively attractive, and I'll share with you why. So over that same 30-year horizon, 10-year interest rates have ranged from a high of 9% starting at the period to a low of 1.3%, and so that's sort of been the range that 10-year interest rates have been in over the last 30 years. And the average over that 30-year period is 4.3%. Today, 10-year interest rates are at 1.8%, and so basically your investment alternatives are all seeing their kind of potential returns compressed. And I think if people who study the real estate markets, I think we'll see the same, where it's like maybe historical cap rates have been about 6.5% or something like that, and now they're compressed to 4.5%. And the nature of that is there's a lot of money out there, and it's a competitive field, and people are looking for good returns. But I'll share with you sort of the optimistic view on the S&P, because I am bullish on America, and I'm bullish on the S&P. And I think that the stocks are priced for about a 7% return for the next 5 to 10 years. And so basically, if you so a PE ratio is something a lot of people who invest in stocks talk about. The P is price, the E is earnings, and so what you can do is you can do 1 divided by the PE ratio, and that of course gets you a E to P ratio, or the earnings divided by price. And so for people who like invest in real estate, that number is something maybe more comparable, like a cap rate or an earnings yield or a free cash flow yield, or these sort of metrics. And so historically, the S&P is traded at 16 times PE, and if you do 1 divided by 16, you get 6.25%, and that's sort of like the historical earnings yield for the S&P for 3 years. The historical 10-year interest rate has been 4.25% over the last 30 years. And so on average, the S&P has sold for about a 2%. The earnings yield in the S&P has been at 2% higher than that on the 10-year yield, which makes sense because you're investing in stocks. It's inherently risky. The cash flows are unpredictable, and so there's been about a 2% premium versus 10-year yield. And so today, 10-year interest rates are at 1.8%. If you apply that same 2% premium, stock should be selling for about a 3.8% earnings yield, and that would equate to about a 26 times PE. And if you do the math on that, that would work out to the S&P 500 being at 4,500, which is about 45% higher than where it is. So you could actually argue that the S&P has 30%, 45% upside to fair value from where it is today. And I'm not saying that's going to happen tomorrow or the next day, but like there's two sides of the there's two sides. It's like there's the risk that the S&P drops 20%. There's the risk that S&P goes up 40%, and you're sitting in cash and you look like a sucker. And
Yeah.
and so, I mean, I think, and I'm not saying the S&P is going to 4,500 like tomorrow or next year, but like. Right. I'm confident that the S&P will be at 4,500 at some point in my lifetime, and it's probably going to happen the next like 5 years. And so, I think kind of sticking to the path and kind of continuing to invest for the long term is prudent now as it has been.
Yeah, definitely. I think that's a really good take on that. Let's see here. So we got a question about the tech sector. What do you think about the tech sector? Is it a bubble forming? And any reminiscence of the 2000 crash? What's your opinions on that?
Yeah. So I think you kind of need to parse that a little bit more finely. And so I think that if you look at like the technology stocks that like the largest technology stocks like Facebook and Google and Apple and Microsoft, Amazon, like I don't like those companies all have large amounts of revenue, generate tons of free cash flows, and I think are priced. They aren't priced obscenely high relative to their free cash flows. I think so. I'm not worried about the tech sector in aggregate. I was the lead research analyst at PIMCO for the technology sector, and then in the fund that I manage now, a lot technology is one of the sectors that I focus on. So I spend a lot of time kind of looking at these. However, I do think that there are areas of the technology market that are potentially dangerous, and I think that the last like 5 to 7 years, there's been extremely low interest rates, extremely easy money, and some venture capital funds have raised large amounts of money, and so I guess I do worry about the valuations of fast growing cash burning businesses such as Uber and Lyft and WeWork and a lot of these venture backed companies, and so. I think that area of the market, and a lot of them are privately held companies. I think that area of the market is risky, and frankly, I would probably stay away from new IPOs and this sort of thing, and especially for cash burning businesses that are growing rapidly. I think that a lot of them people have kind of priced in growth continuing forever, and under the assumption that they will. Eventually get to some large profit margin and dominate their market. And if you study history, companies like Google and Facebook, which have gone on to become, phenomenal investments, even in their early days, in their infancy, they were break even or profitable. And so for these businesses to say, oh, we're doing, $1 billion in revenues and we're losing $1 billion in profits, so we have $2 billion of costs, like it's there's not really precedent for those companies turning around and becoming wonderful investments. And so it will be interesting to watch. But I guess my advice would be to avoid companies that are losing large amounts of money.
Makes sense. And that was actually the next question is, we've just been having this crazy outflow of IPOs. There's just this insane amount of tech companies that are IPOing. It's become like almost like a millennial fad to like try to invest in these companies and see if they go up or down. You got like Beyond, and you mentioned Uber and WeWork and all of that. I mean, is an IPO ever a good investment? Is that ever something an average investor should buy into, or is that something that you should hold off on?
I've seen it happen before that an IPO is a good investment, but as a basket, as a category, you have to think about incentives. And when somebody decides to sell a piece of their business to somebody else, they can kind of choose the timing for that often. And so, usually these people who are selling their businesses know a lot more about the future of their business and how the business should be valued and these sort of things. And so if somebody comes to you and it's like, hey, do you want to buy a piece of my business? Like, the odds are, it's a good time for them to be selling it. So my observation is that, over, multiple decades, the history has not been particularly, participating in IPOs has not been a particularly lucrative practice in aggregate. And there are definitely exceptions to that. And, some people specialize in, trying to pick out which ones are the exceptions. But I think that as a basket, you're better off owning companies that are in the S&P 500, and I think you'll do better than buying a basket of companies that IPO.
Okay. And what company or sector are you really excited about?
So the type of research that I do is kind of very like company specific, and so unlike, I guess what I do is sort of the opposite of what PIMCO does, and I don't really make a lot of like macroeconomic predictions about where interest rates are going to be or where the stock market is going to be. Instead, what I try to do is basically the area of the market that I focus on is companies that are less than $1 billion market cap. So most of the companies that actually I'd be surprised if any of your users know any of the companies that are in my portfolio. They're all smaller companies, and so I get really excited when I find a company that has recurring revenue, low customer concentration, customers that love the product, high gross margins, high return on invested capital, and management team and board that own a lot of stock. And so I've got a small portfolio of about 15 of those stocks that I'm very excited about. Categorically, I'm not particularly excited about one sector or another. I mean, I think I'd say I'm excited about the long-term prospects of the S&P 500.
Okay, yeah, fair enough.
I'm excited about America's prospects versus every other country.
that's a fair.
I'm a bull in this country, so
yeah. That's kind of been the theme of our whole talk tonight. And then, next question. How do you feel about dividend payouts versus stock buybacks?
I think I'm, the kind of theoretical, financial decision is that, they're both returns of, sorry, that's my risk manager is losing it. There's someone at the door. So I mean, I think financially they're both like a return, basically the business returning capital to the owners of the business. It's two different ways. Basically with dividends, it's a taxable event. With share buybacks, it's not a taxable event. And so I think that I have a slight preference toward share buybacks because it's more tax efficient from like a theoretical finance perspective. Yeah. But the practical, practically, I think they're both kind of return of capital, and they're both sort of if a company's worth $100 billion in a given year, they spend $2.5 billion on buybacks and $2.5 billion on dividends. Like, I don't think the outcome for shareholders is a whole lot different if they spent $4 billion on dividends and $1 billion on buybacks. The people would pay a little bit more tax in the second scenario, but they're practically the same. I guess dividends do have a little bit more of like a sense of permanence and stuff. But the one thing I'd say about dividends is that some of the most dangerous stocks that I've seen sell for very, very high dividend yields, and oftentimes they lure in retail investors with this high dividend. And the reason it sells for such a high dividend is because the company's cash flows are not covering the dividend, or the company's cash flows are declining and will not cover the dividend in the future, or the business is highly leveraged. And so oftentimes, when a dividend gets up above, in today's market, if a dividend gets above 4%, it usually means that it could be there's a much higher risk that the dividend is cut. And so usually, like for a sound dividend investment policy, it's like finding these like large companies that are in the S&P 500 that have grown their dividends for the last 20 years or 10 years or whatever it is. Mm-hmm. And oftentimes if the dividend is above 4%, it means that it's either not going to grow, or the underlying cash flows the business generate don't cover the dividend. So I would just be wary about investing in stocks that have abnormally high dividends. It does not mean you're going to get abnormally high return investing in them.
That's definitely true. Yeah, one of my early stock mistakes, I invested in a REIT that had an 11% return, and I thought that was, or 11% dividend. I thought that was so great, and that thing's basically worthless now. So
exactly.
So it didn't quite work out the way I thought it would.
Right. Exactly.
All right. And then we talk a lot about value investing on our group, Intelligent Investor, Benjamin Graham, all that, the old school method. Is that coming back, or is growth investing continuing on?
Yeah. So it's kind of it's a funny distinction, because I think that, So my I think first I'll share kind of how I think the finance community, and when you listen to CNBC, how they describe it, or you read articles. Effectively, the delineation between value stocks and growth stocks are whether it sells for a low PE or a low price to book or something like that. However, if there's certain sectors where the companies trade for lower PEs because they have a lower return on invested capital and all these sort of things. So, for example, a bank is almost never going to sell for 20 times or 30 times PE because it has this it has a certain type of return on invested capital profile, and it's leveraged, and so like a bank is usually going to sell for 9 to 13 times PE, and so so the distinction between value and growth is more of a distinction, as it's kind of described in popular media. It's more of a distinction between what's outperforming, financials, energy, materials, or technology and healthcare companies, and which one's doing better. And so it's and that's financial or technology and healthcare companies tend to sell for higher price to earnings ratios because they don't because they can oftentimes grow organically without any additional capital, and so it's the kind of popular narrative is basically oh well, the last 10 years technology and healthcare stocks have outperformed banks and energy companies, and that is true. But I guess the way that I kind of interpret value investing is basically figuring out how much a business is worth. That could be a software as a service business, or it could be a bank, or it could be a mining company, and you figure out how much it's worth. If you're going to buy the whole thing, or if you were going to hire bankers to sell the business, and you're going to say, oh, I want to sell this thing, what is it worth? And then assessing what it's worth, and then trying to buy that business for less than it's worth. That's kind of what I consider value investing. And so you could my interpretation of value investing is you can have a stock that's selling for 50 times PE, but in reality, if you hired investment bankers and you were to sell it, it would sell for 100 times PE. And the reason for that is they have they could have a huge runway for future growth. They could be suppressing their earnings because they've hired a whole bunch of sales reps in order to grow faster. And there's all sorts of reasons why. And so I think the way I interpret it is I want to find businesses that I understand and I know what they're worth, and I buy them for less than they're worth. And then for my style of investing, I kind of take that approach one step further. And so rather than just looking at maybe what the business is worth today, I try to figure out how much revenue and free cash flow the business will generate in 3 to 5 years, and then knowing what I know about the quality of the business and the industry they operate in, I'll kind of figure out how much the business is worth in 3 to 5 years, and then divide by the shares, calculate the future price, and compare that to the current price, and then buy businesses that have the best return over the next 3 to 5 years. And so that's I guess some people would call that growth investing, and I invest in companies that are growing, but I think I'm buying them for less than they're worth. And so I think it's kind of this it's a fuzzy terminology. So I guess to answer your question, the popular media narrative, do I think value stocks, meaning banks and energy companies, are going to outperform technology stocks and healthcare? I don't necessarily think so. I mean, I think they they each got a 50-50 shot. I know technology companies and healthcare have done better for the last 7 years, and their valuations are much higher than they were 7 years ago. So then there's probably just as good a shot of banks and energy companies outperforming technology and healthcare. And so that's I would advocate for buying the S&P, because then you get both banks and energy, and you get healthcare and technology, and so you win either way.
Okay, yeah. All right. And then, so on our group, we've got a lot of seasoned optometrists, a lot of seasoned investors that are looking to diversify. And so tell us a little bit about Topline. Tell us a little about what you do and your clientele and what you're doing with the fund.
Sure. Well, so I think, Topline Capital is a research-driven, growth-oriented fund. And so the legal structure is a hedge fund. The objective of the fund is I'm trying to beat the S&P by 10% per year before fees, measured on a rolling 3-year basis by owning 10 to 20 growth stocks. And so the sectors I focus on are software, payments, healthcare, business services companies. The area of the market I focus on is companies less than $1 billion market cap that are listed in the US, Canada, and Australia. So there's about 8,000 of those companies. And so I'll going to go through those 8,000 stocks twice a year, looking for what I think are high quality businesses. So I'm looking for businesses that have a track record of organic growth, recurring revenue, low customer concentration, high customer retention rates, have really happy customers, have high gross margins, a management team that owns a lot of stock. And so what I'm looking to, and so I'll basically go through that list twice a year, flag a few hundred of them as being interesting. I'll read their SEC filings, transcripts, press releases, and kind of narrow that list further down to 30 to 50 companies. I'll spend a lot of time on the phone with management teams. So I'll talk to the CEOs and CFOs of these companies to understand kind of what their business does better, the quality of their, basically how strong management is, and I'll fly out and visit with management, spend a lot of time like in the field. But the objective of all the research is to try to figure out how much revenue and free cash flow the business will generate in 3 to 5 years, and thus figure out the value of the business in 3 to 5 years, and then basically build a portfolio of these few stocks that I think are really high quality companies that are going to be worth a whole lot more in the future. So the fund has about $35 million in it. I'm the biggest personal investor in the fund, and and I've got I guess 23 limited partners, mostly like high net worth individuals and stuff. But I think I think like just to be clear, like categorically, I am like very, very negative on the hedge fund industry, because basically what you get by investing in a hedge fund generally is that you get low returns and high fees, and so both those things are bad for your
I remember we were talking about this, yeah.
So just to give you guys like a sense for the prestige of the industry that I operate in, there are more hedge fund managers in this country than there are Taco Bell managers. And so it kind of shows you like a level of like how prestigious this industry has become. And so that was actually Peter Thiel's quote like 10 years ago or something like that. But so there's about 8,000 hedge funds in the U.S. and the industry peaked in 2010, and since 2010 there's been basically more funds closing than opening, and it's been kind of steadily declining. And so I would guess that in the next 10 years, the number of hedge funds out there is going to decline and fall in half again to about 4,000. And the reason is that people are getting smart about what you guys are talking about and going to low cost index funds. And most managers can't beat the S&P, and they can't deliver. Basically they don't have a viable investment product. And so I think the industry is kind of moving your way, and so I kind of keep up the good work there. But I think like from my perspective, like I'm really excited about the kind of the future for my business in the future, kind of the investment opportunities, because there's what's happening in the fund management industry is that the smaller funds are closing and going out of business because they don't have enough scale to keep the lights on, and then the bigger funds are getting bigger, and so there are fewer people kind of looking at these smaller companies that I'm looking at, and so I feel like my my competition's kind of systematically going out of business. And so I feel like it is kind of an area of the market that's becoming a little bit less efficient. And so I'm finding lots of good investment opportunities. And but I would not recommend investing in hedge funds.
Fair enough.
The takeaway. But at the same time, I don't have any money in S&P index fund. All my money's in the fund. So
right. But yeah, if people are interested in contacting you, what's your contact information? How can they get a hold of you?
Oh, sure. Yeah. If you want to chat or something, you can shoot me an email. My name's Collin, and my email is just Collin, COLLIN @ Topline Capital, TOPLINE capital.com, all one word. Collin @ toplinecapital.com. Happy to talk for a few minutes or whatever. But yeah.
Awesome. Yeah. So we're going to head off live now, but yeah, Collin, thanks for joining us on this live event. And if anyone is looking at this live event later on and has questions, just PM me or Dat. I can send them to Collin, and we can get an answer via email. So I'm going to go off live right now. Thanks.